Good morning, viewer. Welcome to our first activity. Here is the breaking news. Yes, Hong Kong stocks plunge 6% as fears about this third Trump China GDP data. Hong Kong stocks had their worst day since the 2008 global financial crisis. Just a day after Chinese leader Xi Jinping secured his iron grip on power at a major political gathering. Foreign investors, spooked by the outcome of the Communist Party's leadership's reshuffle, dumped Chinese equities and the yuan despite the release of stronger than expected GDP data. They are worried that Xi's tightening grip on power will lead to the continuation of Beijing's existing policies and further dent the economy. Hong Kong's benchmark Hang Seng HSI index plunged 6.4% on Monday, marking its biggest daily drop since November 2008. The index closed at its lowest level since April 2009. The Chinese yuan weakened sharply, hitting a fresh 14 years low against the US dollar on the onshore market. On the offshore market, where it can trade more freely, the currency tumbled 0.8%, hovering near its weakest level on record, even as the Chinese economy grew 3.9% in the third quarter from a year ago, according to the National Bureau of Statistics. Economists polled by Reuters had expected growth of 3.4%. The sharp sell-off came one day after the ruling Communist Party unveiled its new leadership for the next 5 years. In addition to securing an unprecedented third term as party chief, Xi packed his new leadership team with staunch loyalists. A number of senior officials who have backed market reforms and opening up the economy were missing from the new top team. Still concerned about the future direction of the country and its relations with the United States, those pushed aside included Premier Alwan Keqing, Vice Premier Liu He, and Central Bank Governor Ya Gang. It appears that the leadership reshuffle spooked foreign investors to offload their Chinese investment, sparking heavy sell-offs in Hong Kong listed Chinese equities, said Ken Chiang, Chief Asian Forex Strategist at Mizuho Bank. The GDP data marked a peak up from the 0.4% increase in the second quarter when China's economy was battered by widespread COVID lockdowns. Shanghai, the national financial center and a key global trade hub, was shut down for 2 months in April and May, but the growth rate was still below the annual official target that the government set earlier this year. The possibility that policies such as zero COVID, which has resulted in sweeping lockdowns to contain the virus, and common prosperity, Xi's bid to redistribute wealth could be escalate was causing concern, Chiang said. With the Politburo Standing Committee composed of President Xi's close allies, market participants read the implication as President Xi's power consolidation and the policy continuation. Yet, Mitul Kotecha, head of emerging market strategy at TD Securities, also pointed out that the disappearance of pro-reform officials from the new leadership bodies for the future of China's private sector. The departure of perceived pro-stimulus officials and reformers from the Politburo Standing Committee and replacement with the rise of Xi suggests that common prosperity will be the operating force of official, Kotecha said. Under the banner of the Common Prosperity Campaign, Beijing launched a sweeping crackdown on the country's private enterprise, which shook almost every industry to its core. The market reaction, in our view, is consistent with the reduced prospects of significant stimulus or changes to zero COVID policy. Overall, prospects of a re-acceleration of growth are limited, Kotecha said. On the tightly controlled domestic market in China, the benchmark Shanghai Composite Index dropped 2%. The tech-heavy Shenzhen Component Index lost 2.1%. Beyond the report for TV.